Hey everyone, welcome back. And for those of you who are new, my name is Peter Tarr, and in 2005 I became a licensed options and stock trading specialist. And this video is on the full story of GameStop, AMC, everything that's happened with that entire movement and where we are today. I'm going to give my perspective and my personal take, and we're going to go over the good, the bad, and the ugly, plus the illegal. And I think some of this might just surprise you. So get ready, because here we go. So let's start with the short story, pun intended. So we take GME and AMC, two otherwise unremarkable companies from a stock trading perspective. And here you can see on the charts that both GME and AMC were trading at relatively low prices. Were these prices appropriate? Were they too low? A reason for such low stock prices is due to the fact that institutions, meaning hedge funds and other organized players, were engaging in a practice known as short selling, whereby their actions were creating selling pressure, which drove prices down, as we can see. But don't worry, we'll explain short selling in much greater detail soon, as it's very important, but for the moment, that's what was happening. And while it doesn't look like much from far away when we zoom out to this multi-year time frame, let me show you what it looked like back then. This is what was happening. And now let me show you what was happening to GME, because it kind of looks like, well, that looks like it was going sideways. Well, not exactly. That's when we moved up. Here's what was happening before the move up, before the big buying phase. So that gives you just a little bit of perspective before we see all this, which is the post quote-unquote meme era. Okay, so we're going to explain what short selling is later, but for the moment, it was happening. All right, now for whatever reasons, this coordinated short selling drew attention of retail investors. Call them Redditors, apes, or whatever other adjective, you'd like, but retail is an all-encompassing and simply means non-institutional, right? It means regular, everyday people engage in trading as a way to generate income and better their lives. I'll refer to them as retail or retailers. Now, these retail investors began communicating with one another about GME and AMC and other stocks. And after digging in, they began to understand that both companies were being shorted and having their prices driven down, right, as we just looked at. Now, we'll get into deeper details later, but they identified some of the institutions who were heavily committed to doing this and decided to begin rallying in the opposite direction, right? Okay. So we've gotten that far so far. Now, what that means is they started to buy the stock and create buying pressure. And we can see these big moves up, right? So this comes when you have strong buying pressure. Now, I'll explain a lot more about that, but they were adding buying pressure so as to drive the price up. As this built momentum, more and more people began joining the effort for a variety of reasons. And I know some of you understand this, but we're just going to go over this because it's all very important. Now, some understood the meaning of the movement and were interested in throwing support into what had become a battleground against institutions that they viewed as predatory, while others simply saw the price going up and wanted to get in on the action, so to speak. So there ended up being a lot of momentum, not just the Redditors, not just regular retail, but everybody started joining suit. And as you know, the word spread, price rose quickly. As we can see here, it just absolutely skyrocketed. The media quickly began to pour in, and we were suddenly looking at an explosion in price. And that's represented by these moves here on GME all the way up. You see we were as low as $257, as high as $483, as low as $1.91, as high as $72.62. So we see that explosion in price. And of course, this did not go unnoticed or without response. So institutions losing a lot of money, I'll explain how shortly, some very interesting things began happening. Specifically, brokerage halted trading to prevent retailers from continuing to make purchases. Institutions began to make noise. Assets were frozen suddenly, and numerous reports began to emerge about people's accounts being liquidated against their will. Said differently, masses of people began to report that their brokers had frozen shares of GME and AMC, then gone so far as to sell them off against their will. Effectively, that not only removed their support from the initiative, but acted in the opposite direction, right? You can see a big move up and then big move down, as this created tremendous selling pressure, right? Everybody's accounts start getting liquidated. That creates selling pressure. Now, It's good to note that every single purchase adds what we call buying pressure, and every single sale adds selling pressure. When brokers and institutions all coordinated to suddenly block additional purchases while reportedly selling assets, this essentially removed an enormous amount of buying pressure and introduced an enormous amount of selling pressure. The result? This is what we saw, right? That big drop from the highs. Okay. Since that time, both stocks have become somewhat of a battleground between retail and institutions. Okay, so what is a short anyhow? Well, first of all, short selling a stock is also known as shorting a stock, and it's fully legal. There's debate about whether it's ethical, whether it's appropriate, and a slew of other questions float around, but it's fully legal practice whereby you sell a stock that you don't own at a specific price. So let's say you sell at $50 with the agreement that you'll buy it back in a set period of time. How can you sell a stock that you don't own? Well, brokerages keep a certain float of various stocks on hand. So let's just assume float means inventory here. They keep inventory on hand of different stocks. When you short, you borrow from the brokerage and have them sell on your behalf at a set price with the agreement that you will buy the stock back to replace their inventory at some point in the future. Now, there are agreements that you'll pay a small interest fee during this period of time and you'll pay your commissions, etc. As such, it's profitable for brokerages to allow this practice. How is it profitable? And how is it profitable to you or to a short seller? Well, we know it's profitable to brokerages because there's the potential interest and transaction fees, also known as commissions. To an individual, well, let's say that you borrow 10 shares and you short sell them for $50. You've now generated $500 through your sale. Then you're looking for a stock to go down so that you could buy it back later at a lower price so that you end up making money. So let's say the stock goes down to $30 and you buy back those 10 shares. Buying back shares is called covering because it means you've covered what you owe the brokerage, aka covered your short position. In our example, you would have sold off 10 shares at $50 and created a credit of $500. Then you bought them back to cover for a cost of $300, right? 10 times 30. So basically you sold for $500 and you paid only $300 to cover them. You made $200 here. Now, how does a short seller get burned? Well, if the opposite from our example occurs and the stock price goes up, that means you lose money. For example, if you borrowed 10 shares and sold them at $50 for $500 total, then the price went up to $60, you'd now have to buy those same shares back at 60 times 10 for a total of $600. That's not good. That means you lost $100 here since your sale only generated $500 and now you just bought back, aka covered, at $600. Now you could choose to hold on. There's no rule saying you need to cover at $60 or any specific number, but you're in a bad place when you're down $100 and paying interest. And you could see a turnaround, but you could also very easily see your losses grow. And any good investor has a risk mitigation strategy. And don't worry, that's just a fancy term for saying that you have a strategy in place to protect yourself from very bad things happening. You should anyhow. But again, you don't have to sell as your losses compile. You could even hold on, or you could even double down. If you ever wondered how people end up with life-changing, devastating losses, probably gives you an idea here. Okay, so you probably have a good understanding of the macro picture at this point. On one side, institutions are driving stocks down and crushing the associated companies, while on the other side, retail is fighting back with buying pressure. When the price goes up, institutions in short positions begin to lose money because they have to cover those short positions or risk deeper losses. This may have sounded like something very simple and innocent at first, but to give you an idea, we're talking about tens of billions of dollars here hanging in the balance. And I probably don't have to tell you this, but no person, business, or institution controlling tens of billions of dollars is without power and influence, nor do they take kindly to their capital being threatened. What lengths did they go to in order to protect their capital? That's hard to say, with any level of precision anyhow. It would be irresponsible for me to work with anything other than the data that I have at my disposal. But let's take a look deeper. Okay, so first, it seems that they doubled down. What do I mean by that? I mean that rather than exiting their short positions, they continued to increase them as retail pushed up. In other words, they dug their heels in. I can tell you from the conversations that I've had within the industry, everyone was unanimous in feeling that institutions would seek to crush retail. And you have to understand that as price goes up, the stakes only rose in tandem. Moreover, this is the unfortunate truth but most professionals hold retail in disdain. That's just the reality, and I could tell you that coming from the professional side. And I can tell you that from countless conversations that I've had, particularly the retail traders involved in this movement. They hold them in great disdain. They are and were viewed by many as, quote unquote, a bunch of dumb kids or sheep lining up for slaughter. So as retail pushed the price up, many of these professionals did not cover. They scoffed and doubled down. Why? Because at a price of, let's say, $200, right? So we look on our charts and we have GME, let's put it about $200. A stock like GME could go all the way back down to $2 potentially, or even less. And a short seller, right, who shorts at 200 and has it go all the way down, nets 198 per share. They could never do that when the price was lower, right? You couldn't net as much because you can only go to zero. So the potential when you're already at $7, well, you can't drive it much further down. But at 198 or 200, you're thinking, I could drive this down to a 198 per share, okay, rather than just a few dollars. So with every single dollar the price moved up from retail, anyone on the other side could have seen it as just a bigger and bigger opportunity to crush buyers. Remember, if you buy at 200 and it drops to $2, you lose $198 per share, right? Like if you're the buyer, if you bought up here and it drops, you get hammered. If you bought here and it drops here, you lose all that per every share that you invested. But if you shorted and it drops, you make a lot of money. Now, keep in mind, there are hundreds, millions of shares being traded here. So you can understand the stakes, right? We're talking about a lot of money. You can see that volume up there. Look at that number. That's a lot of money being moved around. And as I noted, that much money control doesn't come without power and influence. Okay, so institutions begin doubling down and create more selling pressure, but nothing could have ever prepared them, nor could they have ever imagined what would happen. That is, the amount of retail buying pressure shot up like a rocket, right? To use the lingo here, it shot up to the moon, and buying pressure sent these stocks soaring. I mean, look at this absolute absurd amount. This is just a month, right? We're into the billions here. Billions traded on GME. And you can see just enormous amounts. 3 billion shares traded on AMC, right? 5 billion shares. That is absurd, particularly for companies that are being fueled by, quote unquote, a bunch of retailers, apes, Redditors, kids, whatever they want to call them, right? So we see an enormous amount and shoots to the moon, as they say. Now, there's only so much shorting that you can do. That's the reality, since there's only so many shares in distribution. Once you're out of shares, you can't short anymore. You can no longer use this practice to create selling pressure. And if retail is only buying, that means we have nothing but buying or holding pressure left. Make sense? You can't sell off if there's nothing left to sell and all the people with the shares are pushing it up. The shareholders who own GME, for example, say we're holding or buying or there's nothing left to sell. They're hodling, whatever you want to call it. Without selling, there's no selling pressure. Without selling pressure, the stock does not move down. Okay, so let's say that they run out of shares. There's only one way to go, right? If everybody's in tandem, they're buying and or holding, there's only one way to go. You've run out of shares. But what if I told you there was a way to cheat the game by fabricating shares? That is, to artificially insert shares and sell them so as to create buying pressure. That could, in theory, give anyone an extremely unfair advantage, as they could theoretically have an infinite supply of shares which they could fabricate and sell until they achieve their goal of pushing down a price. It would kind of be like playing Monopoly against someone who could just dip their hand into the bank or create money out of thin air anytime they wanted. There'd be no way to beat them, as you'd run out of money first, right? That brings us to our next point. So what is naked shorting? Naked shorting is an illegal practice where, much like shorting, someone sells a stock that they don't own. Only with naked shorting, you don't need to allocate actual shares. You execute a sale without ever actually borrowing shares. Why is this important? Because, as noted, if you don't need to allocate actual shares, then you can theoretically sell an infinite amount of shares until your goal is achieved. In other words, if you're in a battle where you short shares to create more and more selling pressure, then run out of shares, You can't sell anymore, and then you realize you're doomed to losing billions of dollars to a bunch of people that you regard as simple traders, or worse. You could, theoretically, in your desperation, potentially just start naked selling, meaning you could fabricate sales to generate downward pressure and essentially cheat to win the battle, right? Now, there's two important things to answer here, okay? And I'll go in order, and this is important. One, does naked shorting happen? Yes. Yes, it does. That much has been admitted universally. It does happen, and it's illegal, and it should not happen. The reasons why it happens, typically noted as being discrepancies or system errors. However, it does happen. Remember the reasoning that I provided here of discrepancies and system errors. We'll circle back to that shortly, as that's also important. Number two, did it happen during the GME AMC run? Now, I have no evidence that it did, and therefore cannot allege so. I also cannot say with any certainty that it did not, and that's the problem. I know it shouldn't happen, but I also know that it does. Now, remember my explanation as to why naked shorting happens? That's the official explanation. Discrepancies, system errors, right? Delayed reporting, etc. That's the official explanation by the powers that be, the SEC, the feds, etc. It's explained as an illegitimate practice that should not occur, and instances where it does are generally chalked up as errors. If caught, it is a punishable offense. Now, are you ready to maybe blow your minds? Here we go. Okay. I became a professional licensed stock and options trader in 2005. You know this from the intro. Guess what? In 2005, as part of my getting my license, I had to pass various exams, and one of them focused on ethics. Naked shorting was a discussion in the industry back then. Now, guess what the explanation for occurrences of naked shorting was back then? You ready? I'll tell you. Quote unquote, system errors and discrepancies. Sound familiar? That's 17 years ago. Same story as today. A child born back then would be preparing for college right now. A 17-year-old at that time would now be 34 and may have children of their own. You get the idea. Nearly 2 decades ago, and it was the exact same excuse. Technology has advanced leaps and bounds, and the idea of placing a trade online back then was generally a new concept. Today, it's commonplace and data transmissions are lightning quick, yet as I said, it still happens. Moreover, it's rarely discussed on any sort of macro level. So make of that whatever you will. So what's my personal take on what happened? Well, I've laid out the rules. Shorting is allowed. Naked shorting, which does happen, is not allowed. Retail made their move. Institutions fired back. And here's where things broke for me on a personal and professional level. I discussed where brokerages suddenly prohibited traders from purchasing GME shares and that many reported their accounts were liquidated. First, let's tackle the legalities of this issue. Was this allowed? It seems like something that wouldn't be allowed, right? Because it essentially changes the game such that retail loses purchasing pressure by not being able to buy, and worse, by having their holdings turned into sales, all against their will. Is that illegal? Well, from a legal point, no, it is not illegal, as I understand it. And I'm not an attorney, and this is not legal advice. But brokerages do have the right to take action in cases where there are liquidity concerns or volatility concerns, and they can take other actions that they believe are protective. In this case, they use that ability to act on retailers. This is the sort of thing you find in the fine print when you're registering, right? Now, here's my take. To be brutally honest, and I'm sure my attorney is going to love this. I think it was all absolute garbage. There's no eloquent way for me to say it, but that's my response at the time. And I maintain, I think it's absolute trash. Garbage, a joke, dirty and ugly. Legal? Yeah. Trash? Also, yeah. Why? Well, let's break this down. And this is now we've moved into my candid take as a professional in the industry and my personal take. So first and foremost, you might be thinking, why does this guy care? He's a professional, he has wealth, he's a former CEO. Isn't he on their side? The quick answer is I am and always will be on the side of playing fair, right? That's how I chalk up my sides. I don't care what game or competition I'm involved in, it has to be fair. My story is I'm the son of two immigrants. We grew up without a lot, to put it to put it mildly. And the only thing that kept my head up was a belief that I'd have my turn to play the game one day and that I'd succeed based on merit, right? So playing fair and having set rules for everyone, including the poor little guy growing up and struggling, that's everything to me, right? And that lights a fire in me. And I don't care about how much wealth I accumulate. If that principle no longer resonates with me, then everything I am, everything I've done is worthless, and I'm just a fraud. So it has to be fair. There's going to be winners when it's fair. There's going to be losers. I get it. I'm all with that, right? If I lose my shirt, that's fine. That's my choice. It happens. But I can never move up if we don't have a proper playing field. Now, on a macro scale, consider this. If everyone said they don't want to play the game that is our economic system, we'd be on the brink of chaos because of a bunch of bad faith players ruining everything. And that's part of why I want to try to help people and say, look, this is how we even the odds. I can share some of what they know so that you can punch back, right? Because I don't want that chaos. I want the game to continue. I just want it to be fair, right? But that's what it would be. Now, I'm not saying anyone here is guilty of bad faith, but let me go on here. Now, there are some other issues that I kind of took with this whole situation. Not only did what we described earlier, the freezing of assets and liquidation, it didn't happen with one brokerage, right? It seemingly happened across the board in an instant. And can I prove that it was coordinated or that a quote unquote phone call was made from a higher power? No, I don't have evidence of that, and I therefore cannot allege it. However, here's what I can say. In all of my 17 years since becoming a professional, I've never seen anything like this happen in such a tightly coordinated way where everyone took action at approximately the same time. Okay? Not once, not even close, nothing like this. Moreover, I noted that it is legal for brokerages to take action here when there are liquidity or even extreme volatility issues. They can do that. Many attempting to place a trade were given the message stating that they were not permitted to do so for their own safety, that they were being protected from extreme volatility, and that was the reason for not being able to place a purchase order. Now, I'll be clear. I have never in all of my history seen a similar message like that run across the board. Okay? I've never seen quote unquote protective action like that so invasively applied. I've traded volatile stocks and derivatives a countless number of times. And early on, I lost paycheck after paycheck trying to become a better trader. I also know for a fact that there are countless others just like me who didn't end up okay, let alone building wealth. I mean, countless others who lost every dollar they had, who lost their vehicles, who lost their homes, their savings, all trading high volatility stocks and financial instruments, like options, derivatives, etc. Now, I'm not asking for anybody for any sympathy. Obviously not for myself, because you probably know my history by now. I've been a, Fortune 50, two-time Inc. 50, CEO, trader, all that stuff. You get it, right? I'm not asking for anybody for sympathy. I wouldn't deserve it had I lost either. I'm not asking for sympathy for anybody else or saying that they should receive it. Okay? Everybody who engaged did so on their own free will. But the key word here is free. Free will in a free market, because that's the expectation. If I live by my free will, then you have to give me a free market. It goes both ways. But where the heck, this is my question, where was all the protective help back then when people were losing? Where were the benevolent ones, where were these benevolent ones stepping in to prevent me from losing 80% of my savings over 3 days back in the day? Were they preventing overzealous traders from losing his or her life savings? Where were they? And how come this hasn't happened since it happened with these stocks? How come it was isolated, right? This is why I say garbage, nonsense, all right? The only time in history this ever happens on a mass scale happened to align with the interests of large hedge funds who were in a desperate position with billions upon billions of dollars on the line, and it happened suddenly in what appeared, again, I have no evidence that this was coordinated by any higher power, so I have to be fair and say, happened suddenly in what appeared to be a highly coordinated fashion. Now, I won't say the words that come to my mind to describe this, as I want to keep this as professional as possible, but you're free to use your imagination. So hopefully that gives you some insight. Were things legal? I hopefully answered that question. Do illegal things happen? Yes, they do. Was the action taken to the detriment of this move legal? Yes. To the best of my understanding, it was. Have I ever, in all of my years and all of my experience with thousands and thousands of days in the market, have I ever seen these strategies being employed at this scale other than this one time? No. Make of that what you will. All right. So hopefully that was insightful. I gave you my opinion. A little bit of that, of course, is my personal take, and I tried to separate which is the professional observation and breakdown, which is my own personal take. Why? Obviously, everybody has their own story. Some people think I'm silly for even engaging with retail. I've always said this, there's not a lot of good information sources out there because most of the good traders, they're nowhere near Twitter or social media. They're doing their thing. They're on Wall Street or they're just trading privately. But I do my best to help everybody. If you want to learn more about stock and options trading, I provide free education via Twitter. My username is Profits Taken. You can follow me there. My website for those interested in diving deeper is profitstaken.com. But more importantly, I really hope this was educational. And thank you for tuning in. If you're intent on trading, please just do this. If you're new, if you're pivoting from the sort of GME, AMC days and trying to learn how to trade, take your time, protect your capital, educate yourself. Anybody promising you any kind of quick fix, ignore them, tune them out. There's a lot of bad players we know professionally. I'm not going to say anything about institutions or major players, but there are bad faith players out there, and there's tons of them on social media just looking to make a quick dollar. So protect your capital. You work hard for it, learn how to trade, and then progress. I'm happy to help if you want to follow me on Twitter. And again, I hope this was informative. Thanks, everyone, and we'll see you soon.